target an FMCG distribution business, currently franchising and distributing for Zara Cosmetics in Kenya. So the challenge was the business, really. You know, I happened to grow a business over the last 5 years. And then one day, not one day, like over a period of time, I was just having challenges. One day it's consignment clearing, another day is HR, another day is a different thing. And I got to a point where I was just telling my husband, I'm ready to just close the doors and go home and raise my children. And then I started interacting with the Sandbox experts after that. During one of my interactions, I interacted with Kirinya, one of the directors of WYLDE, who introduced and recommended that I attend Scalarizer. I have learned how to identify the customer and how to speak to the customer. I mean, not just the customer, but how do then you get to your target market? How do you speak to them? What language are they going to hear? And so that has led to, smaller resources going to the right direction and reaching the right client and bigger impact with less resources. I attended a one-day workshop with other entrepreneurs conducted by the best trainers, I believe, very clear on, strategy being a response and not a reaction. And going through Scalarizer helped me be very specific on what are the pain points and being prepared. It would be very difficult to say I'm at 10%, 20% implementation of everything I needed to do. I now have a fully implemented ERP system, and I have an outsourced HR person who has helped and trained the team on onboarding, managing resources, being HR, contracting, having specific job descriptions and performance reviews every so often for the team. Have I tried others? Maybe at the time of struggling and thinking how you can get yourself out of the problem, I tried thinking of probably setting up a board of directors. And so I had done this course for board readiness, and then Scalarizer made it even different by showing me not just getting other people on board who might just struggle as much without systems, and it was simpler just setting up the systems first, which is interesting because the systems have been able to resolve all those issues that we were having. I would very much recommend Scalarizer to business owners. So would I still do it 5 years in? I would. And even better then, when you already have built, and the issue is probably laying down the structures. So it still works for both, whether you're starting the business and you want to come up with a strategy, identify what you need to invest in to achieve the overall goal that you're trying to achieve. I would recommend it.
In the world of business, particularly with small and medium-sized enterprise, success requires more than hard work. You need a special ingredient that can actually help you to accelerate your business and to become successful. I'd like to introduce you to Scalarizer. Scalarizer is a concise and affordable strategy workshop that comes to you in a bite size and in a way that actually allows you to consume it within a very short period of time and to achieve the basic steps that you need in your business to succeed. This one-day workshop condenses weeks of knowledge into practical action that can help you get to the success points that you need to implement in your business. Over the last 3 years, more than 104 businesses from more than 10 different sectors and industries have taken the Scalarizer program. These businesses have reported 50% growth in their revenues within 3 to 4 months of taking the program. The Scalarizer program is designed for SMEs who have been in existence for more than 3 years and have a turnover of more than 3 million Kenyan shillings. The Scalarizer program works perfectly for business owners or entrepreneurs who are passionate and are looking for exponential growth in their businesses. The Scalarizer program is delivered by experienced business strategists who have been working with SMEs over the last 10 years. During the Scalarizer workshop, you will interact with other entrepreneurs and learn from them. You will be taken through practical exercises that are relevant for your business, and you'll also receive hand-holding support that is specific and meets your business right where you need the support. Visit our website to learn more and secure your spot in our next Scalarizer workshop. Unlock your business potential now.
Good morning, everybody. I want to presume we are on the side of the equator where I can say good morning, but I will also say greetings, good day, most welcome to this webinar. My name is Njeri Lucy. I lead the cluster for technical assistance. We are all about supporting you entrepreneurs. So most welcome. If you know anybody who is interested in the conversations about money, because business is about making money impactfully, sustainably, kindly get them to be here. And we know one thing about entrepreneurs: we are the chief salespeople. And so because we usually hear in the corporate sector, you have your elevator pitch. That means you know how to speak about yourself, your career, or your title, and what you do. We want to do the same here. So kindly go into the chat section of Zoom, introduce yourself briefly. So, of course, that means your name, the name of your business, and one line what you do. Okay, we got that? Because it's important for us to know who is in the room. And as we like to say, you never know. The person in the room could be the source of your breakthrough, the source of the connection you're looking for. In Kenya, we like to say, you know a guy who knows a guy? That guy is in the room today. So introduce yourself in the chat. As you do so, I'd like to say this webinar is brought in partnership with two organizations. One is WYLDE International and the other is Renew Capital. We are working together to ensure that you have the requisite expertise you need to run your business and the finances that you need to be able to scale and to grow your business. So most welcome to this conversation today. You want to know how to get into the mind of the investor? You are in the right place. So get your friends into the room as well. So am I seeing conversations? We have pharmacist here, a pharmacologist, most welcome. Thank you very much. Get the conversation going. Introduce yourself. We enable visions, manage resources, ignite succession from beyond gaps. Excellent. Smart properties. Keep the conversation going. Introduce yourself in the chat. I like this person from South Sudan. Most welcome. Operations manager from Smart Properties. Thank you. Thank you very much. Those who are joining us from the diaspora, you are most welcome. Please keep the questions for the question and answer section of our Zoom. Keep the questions to write them in our question and answer section in the Zoom. So let's keep introducing ourselves. We have someone from SNICOP, we have someone from Fixo Solutions about plumbing and electricity and carpentry. We have a student who would like to join the investment world. Allow me to just point you out and say, Hannah Dawit, most welcome. This is how to get started. We have Rama, we have Wood Interiors from Eldoret, Climate Energy Business, most welcome. So keep introducing yourself because it's important for us to know who is in the room. It's important for us to introduce ourselves because, as we say in business, your network is your net worth. For someone to be able to say they've watched for you either because you have been their customer, you have been their supplier, and in this conversation today, you have been their investor. it's important for us to know who is here. So I have already made a mention about the partners in the webinar, and I will speak about one of them, which is WYLDE International, so that I can give you a good amount of time to listen to the conversation about investment. Now, is it possible for me to have some sharing rights? I'm just going to make a very brief presentation. Once that is done, let me know. Let me give it another try. Can I share my screen? As I am being assisted, I'd like to make mention of my colleagues, Robert Jenga from WYLDE International, Mike Monia from Renew Capital, and we'll be introducing our guest shortly as well from Renew Capital. Super, excellent. Thank you very much. So briefly, who is WYLDE, and how do we have the privilege of being able to host this session together with our partners, Renew Capital? We are over 2 decades old, 21 years now. We are an enterprise support organization. We support you who is an SME and a medium-sized business when it comes to entrepreneurship development, give you business coaching, support you in access to finance and matters research, as well as market access. So we have had programs around the region, East Africa, and we do have partners around Africa. And we also, through those programs, we have business coaches. So let us know from whichever country you are in, we'll be able to support you, because we believe in something that we call entrepreneurial empathy. So whereas here in Nairobi, where we are broadcasting this business webinar from, we can coach you. We know that your own in-country business coaches will be able to understand the environment better. So do let us know, and we can begin working with you the journey. Whereas we are sector agnostic, currently our 3 priority areas are about entrepreneurship, agribusiness and climate, digital and creative, that are aligned to the 4 SDG areas, which are about being able to have agribusiness value, supporting entrepreneurs in that sector, empowering women economically, being able to see that entrepreneurs are succeeding in what we call decent work, and as well as aligning around the global green climate agenda. In the space where WYLDE International works in is a space that is called Sandbox. So that is how you pronounce it, excluding the vowels, okay, when we are writing it. And when we say we are a one-stop shop for SMEs in the world, we say it is SMEs supporting SMEs. Wherever we are setting Sandbox, one of them right now in Atlanta, another one coming up in the UK, among as many other satellite offices around the world. We say the expertise that you as an entrepreneur has can only be understood best by a fellow entrepreneur as a first point of understanding what is the business case or need that you have. We are a trusted global network, and so that country that you are in, if you'd like us to set up a Sandbox there, do drop us an email. This is how Sandbox works. So for WYLDE International, we are in the value engine. That means any support that you need as pertains to strategy, human-centered design, any support around sustainability or getting the data to be able to grow, you know you are in the right place. And the rest of the about 30 to 35 experts that are part of Sandbox, they are in the various engines that are highlighted there. You'll allow me not to read them because, as I said, today the conversation is about money and your business. These are some of the partners that we have worked in. Now, considering that a good number of you may have been some of our clients in the program, I'm sure you can see some funded your programs, and we continue to grow the number. Some of the areas have been around blue economy, agribusiness, creative industry, and supporting you digitally. These are some of the solutions that we have offered you, but they are not limited to these, whether it is outreach, whether it is technical assistance. And in this case, I'd like to emphasize the technical assistance, especially closely related to this webinar, is a pre-investment or post-disbursement, because we like to say money may not necessarily be the problem. The problem would be how do you utilize it to be able to scale your business sustainably, and that it will be etched somewhere in your business that when you got this boost financially, you are able to scale profitably. These are the reasons why you as an entrepreneur would like to work with us. And for this reason, we say you are most welcome once we are done listening to how you understand to pitch your business, so that the entrepreneur can see the value that they will be bringing, as well as they can see the value that your business does bring as pertains to being able to partner with an investor. We are here to be able to support you. Now, I'd like to introduce someone I call the man of the moment, the person that you all have been waiting for. And it is because we need to be understanding how do we position our business to be able to attract and continuously keep these conversations with the investors worth the while as pertains to growing our businesses. So I'd like to introduce Lucas Robinson, who is a principal at Renew Capital. He is experienced in investing and running businesses. He has over 20 years experience. Notably, he has been a co-founder for Limalio Lodge in Ethiopia. If you're in Ethiopia, you can go and look at that. The Treehouse Project in Zimbabwe, and then Power Ventures Africa. He has extensive experience in managing the interface with development finance institutions and aid agencies, has worked in the UK's Department for International Development and Canada's International Development Agency. He holds a master's, an MA honors from George Washington University in Washington, D.C. in the US, and a BA honors in the University of Toronto in Canada. Ladies and gentlemen, allow me to welcome Lucas Robinson. Lucas, take it away.
Thanks, Njeri. Thanks for that warm welcome. And it's a pleasure to be with you all. I hope I can live up to the billing. I'll take over the screen sharing. Let's see if that seems to be working. Yeah, good. Excellent. Well, we have a lot to, or my hope is that we have a lot to cover today. So I'm going to dive right in. But can I start by thanking all of you for, first of all, for joining, and secondly for putting in the chat what it is that you do and or what it is that you're building or trying to grow as an entrepreneur. It's really great to have the context, and really just nice to see the excitement that you bring to the session today. So I've been introduced, and unfortunately we probably don't have time to go through a full round of intros from everyone. So that the intros that you put in the chat are really helpful. But I'll start by going through the purpose, outcome, and agenda for today, so that you have a sense for what we're going to cover. If this doesn't live up to the billing, then of course I take no offense if you've decided, gosh, I thought we were here for an agriculture training program, and and Lucas definitely doesn't look like a farmer to me, so I'm out of here. If that's the case, no problem. But if you are here to learn about what investing in Africa looks like from the point of view of an investor, then you're very, very welcome. So the purpose of today is to share what is I hope will be a very honest, but it's very biased perspective on how to help companies navigate the investment journey and to secure the capital you need to grow. I hope you'll come away from this knowing roughly, or at least a start, to what it will take to secure financing from a private investor and some practical moves or actions that you can take to set your company up for success. We've got about an hour to go through all of that, and then we'll take your questions. So, and I always find the questions are the most fun, to be honest with you. So I'll try to get through that as to this part as fast as I can without skipping too much so that we can get straight to the questions. So we'll cover a little bit about, I talked about how this is a biased perspective, and I'll explain why that is in a second, but through an intro to Renew Capital, the company that I work for. We'll get into the investment mindset, the types of capital that are potentially available to you as a founder, what venture capitalists look for. This is a very narrow type of investor, pitching, closing a deal, and then finally the Q&A, as I promised. So let's dive right in. And I know you're keen to get into the investment sort of the kind of the point of this whole thing, but it's important for me to explain our biases as an organization so that you know where we're coming from, because every investor has their biases, and we're no different in this regard. So and this is 2 minutes, a bit of context on Renew Capital. We're helping to solve a $90 billion problem. Africa needs plus or minus 8 million new jobs every year. It's probably closer to 9 million actually now. And we firmly believe as an organization that small and medium-sized enterprises are the engines of job growth, not just in Africa actually, but the world over. But it is especially the case in Africa, though even true elsewhere, that small and medium-sized enterprises are trapped in what has now become widely known as the missing middle, where you're too big to get a microfinance loan, and yet you're not big enough to attract the kinds of large private equity investors that might be active in air quotes on the continent. And there's basically, therefore, a $90 billion problem. And as an investor, we're hoping to make our contribution into solving that problem. And Jerry's already introduced me, so I don't need to get into this too much, but as she mentioned, I'm the co-founder of Lima Lima Lodge in Ethiopia, Power Ventures Africa, which is a Pan-African renewable energy firm, and the Treehouse Project, which is a Zimbabwe-based conservation initiative. I just mentioned that because I feel sometimes it's important to just let you know that I know how frustrating it is to be in the position of a small, medium-sized enterprise on the continent that is very excited about the possibility of growing, but struggling to figure out how that growth is going to happen. So a lot of what I'll talk about today is kind of based on my experience in the process, although I look forward to hearing more about your experiences later on in the session. Okay, so with that kind of introduction and sort of statement of biases aside, let me get into what we at Renew Capital call the investment mindset. So this might seem a bit odd to some of you because you're probably thinking, "Thanks very much. I don't really need a new boyfriend and or girlfriend and or husband and or wife in my life. And least of all, do I need advice on that from Lucas." And so I'm not pretending to provide relationship advice here today. But I just want to sort of emphasize the nature of kind of the relationship that you may be getting into with us as an investor, if you were to take on, say, for example, Renew Capital as an investor. And Jerry, can I just double check that because something's just happened funny on my screen. I just want to double check you're still seeing the main screen. Is that still working? Good.
Yes,
okay.
yes, we are.
I can see. Okay, good. Okay. So yeah. So as I was saying, I'm sure some of you are already married, and I'm not looking to play any part in that activity. And so, but like I spend a lot of time talking to our portfolio companies, the companies that we invest in. And it's a really, really important relationship and one that has to be taken very seriously. And it's not the kind of thing that you should go into if that's not where your mind's at, if that's not where your heart's at. Because as those of you who are married know, there's ups and downs in this journey. And there are stresses along the way. And the same is true when it comes to an investment relationship. And so I think it's really important to kind of understand that, you're taking on a new, very significant party, if you will, in your life. And if that's not something that's exciting for you, then I would totally understand personally. Like, yeah, we as an investor, we always want our companies to be really sure that like this plan is part of the plan, part of your plan, and not just something that you're doing because other people tell you that's like a good thing to do. It's also really exhausting. You want to get through the fundraising process as quickly as possible. But the truth is, it's both a marathon and a series of sprints. It takes months. And then when you think you're done, like just when you think like, oh, yes, I've made it, like the process is going to demand more from you. And you haven't, and like, that's just the like financing your business part. You still have to run the business alongside of all of that. And it's really hard to do both of those things at once, especially if you're the CEO and you're not in a position to have some excess capital to hire, say, a COO or a CFO to help you get through this tricky period. So it's going to take grit and it's going to take persistence, and you will be tested throughout the process. That's by design, to be honest with you. Like investors are quite comfortable with that being the case. And as someone who's been through it 3 times and many, many times on the other side of the table, I just want to be really clear that like that's this grit and persistence, it's part of what we look for as an investor, and we feel other investors are very, very similarly minded. Let me give you a sense for the point here, or let me illustrate the point. A typical investor funnel might look something like this. this is just like imaginary, right? So 200 companies are engaged with in some way, right? There's some investor sitting in Nairobi or sitting in Kampala, and she says, oh, Peter, it's really nice to meet you. I like the sound of your business. Like, let's get to know each other a little better. Show me your pitch deck, all that kind of stuff. That's the meet and screen stage, right? Then she's like, oh yeah, this looks kind of interesting. I'm going to dive into this a little bit more. So maybe about 10% of those initial meet and greets become something closer to like a proper set of analysis. About half of those might then go through a due diligence process of some kind, and the ones that will actually close, it's maybe like 2. So 2 out of 100, we're talking about something like a 1% success rate. Now there's several investors, so it's not that like only 1% of small and medium-sized enterprises in Africa get funding, although that probably actually, as I think about it, that's probably like roughly close to the actual statistic. But yeah, I mean, it's like the number's not in our favor as entrepreneurs. I'll give you a very specific kind of illustration, and it comes from Renew Capital last year's process, and we're almost at a point where I could start giving you a sense for this year's process, but the truth is it's very similar. Basically, we had about 3,000 companies come through kind of some form of our funnel, as it were, the like early stage of our investment process. About 200 of those were selected for like basically our mini accelerator program, and then about 100 of those were presented to our investment, and about 30 of those were presented to, it's called the Renew Capital Angels. It's a group of kind of outside investors that invest through Renew Capital into the companies that we invest in. And ultimately, we did about 15 investments last year. So that, in case your math's not as quick as not mine, I'm very slow at math. Even my kids make fun of me for being so slow. That's about a 0.5% success rate. Okay, so now we purposely take a really big funnel. Like we love being exposed to a like very wide range of companies and founders, and so our sort of success rate, if you will, or the number of companies that we invest in out of the number that we initially come up with, is very low. That's not to say, though, that we don't think that the rest of the companies are really exciting or that they're not great companies. They might be great companies. Many of them are great companies, but they're just not right for Renew Capital. And that's a big part of what we'll talk about a little bit later when we talk about pitching, is knowing who it is that you're pitching and what it is that those investors are interested in. There we go. All of this is related to something that what we call at Renew Capital is like related to the right mindset or the investment mindset. And that's what I think many investors, but certainly we at Renew Capital, because we're a very early stage investor, look really, really hard to find. Is the question that we're always asking is really around scale. Does the entrepreneur have a growth mindset or a fixed mindset? And we don't always get it right, by the way. Like, in fact, we're the first to say, like, it's really hard to figure this out. But But some of the questions, if you will, that we ask ourselves is the entrepreneur seeing failure or like something that's like not working as a challenge or an opportunity to grow, or are they thinking to themselves, actually, like, if I failed, like, my business sucked, or I'm not good enough, or this is just not working, and I'm just going to give up, which is like a perfectly human response. And I have no problem with that response generally in life. I get it. But as an investor, what we're looking for is this growth mindset, and businesses that are really seeing the world as their oyster, and an opportunity that exists in front of them, but probably many other people are telling them is not there, and they're fighting against that messaging. So we're looking for people not just that are raising money because they've been told that's what it is that they should do, but rather because they have this vision for where they're trying to go and they need external capital to get there. Which brings me really, I guess, to one of the central questions that I have for companies that come to Renew Capital, which is, are you sure you want outside capital in your business? And maybe the answer is no. But if it is yes, then I think it can be a really great opportunity for certain kinds of businesses, provided that you know what kind of capital it is that you're trying to raise for your company. So let's dive into that now, which is to say, what kinds of capital are best suited for your company? And we'll spend a bit of time talking about, first of all, why take on outside capital in the first place, and then the types of capital that can be helpful for certain situations. So hopefully this vaguely rings a bell for some of you. If the house looking thing is your business, by the way, my kids also make fun of me for how bad my PowerPoint skills are. So if ever anyone's giving you a hard time about your PowerPoint deck, just remind them that Lucas showed you this beautiful image, and that it's actually not the quality of the deck that's kind of going to make or break your business. But anyway, hopefully this rings a bell. Basically, most of the businesses I can think of operate like they've got inputs, then they've got some operations happening, and then there's an output of some kind, whether it's a good or a service, and then they sell that and they collect money, usually, I hope, but I suppose could be a trade of some kind. And then out of that whole process, there's probably some operational expenses happening. And hopefully, if you're really lucky, there's some profits at the end of the day, right? Where you're actually making some real cash. Okay, so let's now say that you're thinking about taking on some outside investment. Maybe you want to buy a new piece of machinery. I saw several of you were in the agricultural processing space, so hopefully this example will kind of ring a bell. If you were to use your internally generated capital, in other words, you were to save up your profits, your profits, let's say your profits are roughly $20,000 a year, and the machine costs like $200,000. Then you're going to need 10 years, right, to save up enough capital to buy that piece of machinery. And most of you are probably thinking, yeah, like, that's crazy. I would never do that. But bear with my basic example here for a second. The point of outside capital is to get you there a little bit faster. Basically, you borrow some money or you receive an equity investment, I suppose. And the outside injection means that you can buy that piece of machinery more quickly, like as in today, and you can start processing more of that agricultural good, whatever it is. And you can then sell more of that agricultural product, and you can generate more profits, such that your profits increase faster than the cost of that outside capital, basically. But if the cost of that outside capital is too high, then you're not going to make any additional profits, and therefore you're not buying the piece of machinery basically just isn't worth it. Now, in the example that you can see on your screens, hopefully, probably some of you are on your phones and you're probably zooming in on the screen. So let me explain it. Basically, the short story is after 10 years, you've made a little bit more money by borrowing $200,000, and you're now 10 years later, if let's say you're lucky enough to get like a 10-year loan, almost unheard of in the African continent, but let's say you're lucky enough to get that. By the time you've paid off this machinery, like now you're really in the money, right? Now it's really working out in your favor. But even before that, you're making more profits than you were. So this is kind of worked out for you. What we in the kind of venture capital space or in the investment space look for, so if the banks, let's be honest, the banks are so conservative, they probably wouldn't even be excited by this, but like if you could get them excited about anything, this is probably something that they'd be excited about. They can basically, you can borrow against the factory or the piece of machinery, maybe, rarely. And the banks might be like, okay, this is good. What most kind of outside investors are excited about is the idea that you would take on lots of outside investment, and you wouldn't buy just one machine, you would buy 5 machines. So you'd borrow like $1 million. And that's when your profits start really looking pretty exponentially high, because you've borrowed quite a bit more. Now you're having to pay off quite a bit more. But your profits are growing much more rapidly. And you can pay off the whatever it is, if it's debt or equity, you can like start generating returns much more quickly. So that's kind of what we're talking about today, in a really simplified way. And the question that I was asking earlier is like, do you want to borrow? Do you want to borrow outside capital? Because maybe it'll generate some additional profits. Maybe in the case of this example, it'll generate lots of additional profits. But you were generating like $20,000 in profits every year. Like, that's okay. That's like, some people would be really happy with $20,000 a year profit. And if you're a sole proprietor making $20,000 a year in Kenya, like, if it's a side hustle, then maybe you're pretty happy with that business. But if you're not happy with that level of profits, and you want to take on additional capital, and you want to see your business grow kind of like this, and see some maybe let's see if I can even do a pen on here. Yes, great. Maybe you see the potential to like go really high, which would, by the way, be really exciting for an investor like Renew Capital. Then that's great. And then you just have to decide, okay, so what does this mean? Like, what kind of money can I go after here? The short story is there's basically 3 kinds of capital. 2, I would suggest, are traditional. One is called debt. The other is called equity. And there is sort of debt like instruments that can be used that kind of maybe look like debt initially, but change into equity. Some of you might have heard of a convertible note. That's what that is. Or there's like equity-like instruments that convert to equity later, but just sit off kind of over here for a little while until some event happens, like maybe you raise more money in the future, and then it converts to equity. That, like a safe note would be an example of that. But basically, there's just these two categories, right? Debt or equity. Then there's also a third category, which is grants. And grants are a source of financing that I'm sure many of you are familiar with, which can be pretty helpful in the initial stages of a business that's aligned to certain impact standards. So grants are generally provided by philanthropic people or organizations like NGOs or development finance institutions, who are more interested in some kind of a development impact than they are in seeing that money return to them. So in one of the businesses, for example, that I was involved with, I mentioned to you, Lima Limo in Ethiopia, we received some grant funding in order to deliver conservation goals for the area that was surrounding the western side of the Simien Mountains National Park in Ethiopia. Now, that grant was really helpful in the early stages of our business because, as many of you know, when you're just getting started, you're desperate for cash, but it's not without its strings, right? We had to do a lot of things in order to, first of all, get that grant money, and also to report on that grant money, and even to deliver on the conservation goals for the organization the organization that was funding us at that time. Sources of debt. Back to the debt question. Sources of debt might be banks, it could be private capital, private lenders, and it usually involves an interest rate, right? Like some kind, like, I don't know, 12% interest, or if it's Kenyan shillings, for those of you in Kenya, might be like 19% interest or something like that. And it's usually priced as a function of the cost of capital plus what the bank or the private lender sees as their risk involved. Equity is usually what venture capital firms, private equity firms, many development finance institutions, and actually public stock markets as well. That's what they're interested in. And that involves the sale of shares in your business to the new investor in exchange for that equity, that capital. They then own a piece of your business. And in many ways, they may have certain rights associated with that ownership. So grants are free, and they're provided by donors or grant-giving organizations, but they are very rare. And they're very unusual in the global context. I think sometimes here in Africa, I'm based in Nairobi. I used to be based in Zimbabwe, before that Ethiopia. I think sometimes we think there's like loads of grants out there. In my experience, they're very difficult to find, especially if it's, especially if your business is not necessarily an impact-focused business in one way or another. Then there's bank debt, and private equity, basically. Grants, as I say, generally available for early-stage businesses, high social impact, and often best suited for social enterprises, maybe you're running an NGO or a nonprofit organization, then it kind of seems to work a little better. But it's free. Although it does involve a lot of reporting. You have to dedicate quite a bit of time to monitoring the money, the funds that you've received and the impact that you're having. Debt, generally, like if you take the flip side of that, like they, generally speaking, not always, there's some financiers that are willing to give you like a reduced interest rate for some development impact, in which case you'll have reporting to do, but also debt payments to make. But generally speaking, debt is involving collateral of some kind. So you'll need to, if you borrow, back to my previous example, if you borrow some money to buy that piece of machinery, then the bank will come and take that piece of machinery away from you if you don't pay them, right? Or they will take your whole factory away from you if you don't pay them. So, you know, it's a pretty serious undertaking to decide if you're going to borrow money from a formal institution like a bank. But you maybe get something like 18 to 15, 20% interest, depending on the currency that you borrowed in. On the equity side, there's kind of multiple stages here, but if I'm generalizing really, really broadly, most equity investors in Africa are looking for growth-oriented businesses because they're willing to take quite a bit more risk earlier on, but they get a share of your profits as you grow. And so that's what they want to see eventually. They want to see profits and they want to see you grow. Or they want to see you sell your business to someone else who's willing to buy the shares from both you and the other investors. So think of it like a capital stack, basically, right? So you've got bank debt, you've got private debt, you've got preferred equity, which is like the kind of equity that a venture capital firm or private equity firm might be buying essentially from you or investing with you. And then there's common equity, which is what you as founders have. And you're taking, nobody doubts, by the way, that you are taking the most risk here. Like, that's clear to everyone. And everyone, well, most investors anyway, should want to ensure that you continue to be highly motivated to take that risk. In other words, that you will see the biggest returns as the entrepreneur that's driving this whole process. But don't kid yourselves that the other investors are going to want some of this return as well. Okay, so should you approach, or should I approach, a private investor? From my point of view, the benefits are you'll get great connections to other markets, investors, and other portfolio companies. If we do anything well as investors, it's that. You'll get access, hopefully, to follow-on rounds of financing if you're doing well. Most investors will help you stay disciplined about your thinking, your strategy, what you're investing in. And they should be helping you with your corporate governance. However, you will generally, anyway, need to give up some ownership and or control of your company. That's the trade, in short. And a lot's going to change because it goes from my company or your company to our company. We're back to my point about getting married. Like, I'm not getting married with you, but like, you know, it's a relationship that's really, really personal, basically. There's increased reporting. There's an expectation of greater transparency. And you really could get fired from the company that you founded if things go really badly. So, you know, remember this slide from earlier? This is what happens when basically the business that borrowed lots and lots of money ran into some bad luck along the way, or some hard times, or, you know, whatever happened. And the bank said, okay, sorry, you don't like, by the way, the bank doesn't want to do this. The bank just wants to get paid. But if you don't pay the bank, then and the bank used your factory as collateral for the loan that you took out, then the bank is going to own your factory. And your profits will then be zero and your company will be bankrupt. So, it is true that you might grow and do really well, but if something kind of troubling happens here and you can no longer afford to pay the bank, then the bank is going to own your factory. So, it's yeah, it's a really big decision. And we always, as investors, we always want to know that that the investee, you as the company, knows what you're getting into. I've done it both ways. Personally, I think it's worth it for the right business, but it's a really important decision. So in case I've overly stress this point, because I worry sometimes that I sound too negative about this, I want to just make sure that I, give you also the most positive versions of this, which is that we do see our job as helping companies raise more money. We offer coaching, we offer training, tools, partnerships with the likes of WYLDE and others that can help you and help your business grow. We can help you grow into new markets, insights. We're Renew Capital's in 13 countries around Africa. We've got people in those countries. We can help our portfolio grow into those locations, amplify portfolio brands, et cetera, et cetera. So, it's great. It really is great when it goes well. And in my experience, it's very much worth it to look for the right investor for your business. Okay, so let's talk about a very particular type of investor, which is venture capital. We are probably the most growth-oriented of the investment types. Private equity firms, generally speaking, are interested in companies that are growing at a steady pace over a relatively like a medium term, I would say. Whereas venture capital firms are looking for massive growth over a relatively short period of time, and we're willing to take a much higher level of risk as a result. So let me tell you what Renew Capital looks for, and I'll try to contrast this along the way with what I see other investors looking for. The most important thing, without a doubt, is back to that mindset point that I talked about, which is that the firm is led by a strong leader, or even better, a group of leaders, and that team is coachable, scalable, and trustworthy. And that, without that, we'd never do the deal. And I appreciate that that's going to sound totally arbitrary. And I think for when I was sitting on the other side of the table, I always had the hardest time with this variable. I was like, how can I possibly show that this person, that that my head's in the game, that my business is scalable, and that I'm a trustworthy founder. And the short story is that that's an art, and not every investor will meet you and feel like they get this feeling from you, and that's okay. That's just part of this process, and it's why it takes many meetings, many investor processes before you find the right investor for you, and before the investor finds the right companies. We also look for companies that have achieved some kind of traction. So we're not so early stage that we'd be willing to invest in an idea. Others will. That's not us. We look for some revenue usually, and if not revenue, then at least some growth indicator. showing that you have found at least that you've got a minimum viable product, if not product market fit. Many of you probably heard that term used before. We'd like to see you using technology to solve unique African challenges, removing what we all know are the many friction points for businesses on the continent, and serving whether it's a B2B, serving other businesses, or serving customers directly, that you're reducing those kind of friction points, and that and you're enabling more and more business to happen. We have a preference, like many VC firms, we have a preference for fintech, e-commerce, software as a service, Logitech, EdTech, mobile first solutions, ag tech included, etc. We want to see that you've got a go-to-market plan, and that is well articulated in the pitch. We'll talk about the pitch in a second. We want to see that you have something special, there's something unique. The product or the service is like not something that we've seen a million times before. But equally, we want to be sure that there's a market for it. Like, if you're selling something that's really popular in San Francisco, but we look at it and we're like, I don't know anyone in Nairobi that's going to buy that, then it's entirely possible. Look, I'm 47. I'm like really conscious of the fact that I don't know what 20-year-olds are buying with their money on a regular basis. So I'm perfectly willing to accept that I'm out of touch on these things, but that doesn't. But you still got to convince someone that people are buying your product. We get really worried about companies that are highly dependent on imported materials and things that require your business to have a lot of forex in your bank account, basically. And that probably, if I'm honest, comes from our 10 years of working in Ethiopia, where access to foreign capital is often very difficult, and businesses that sort of demand that access in order to be successful find themselves really struggling to grow. I appreciate that that's not true in all markets, although I would say in most of the markets that we're active in across the continent, that becomes an issue at some point in time, either because there's capital constraints or because there's foreign exchange risk. And so for both of those reasons, we get a bit nervous. And then obviously we're looking to significantly increase the value of our investment. That's like, we are not unusual in that respect. Every investor, proper investor, not grant maker, but proper investor, is looking to increase the value of their investment. What are other venture capital firms looking for? I would say this is pretty common, although not, it's not true across the board. But most venture capital firms are looking for like pre-seed or seed round, and you're trying to raise less than $2 million, but more than $100,000. If you're only trying to raise $100,000, then to be honest with you, most firms would say, go somewhere else for that. Go find an angel investor, go find a microfinance institution that's willing to lend you part of the money, etc. Most businesses at that stage are valued between, sort of $3 to $4 million, maybe as high as $5 million. But, we want to see that you're, growing, basically. And that if you've pivoted in some way, that's fine. But really, in the last little while, we should start to see your growth numbers like doubling every month or every 2 months, maybe. And that if in 18 months from now, so you get this funding round under your belt, and 18 months from now, you'll be ready for like a new funding round, and that funding round is going to send you into like the really fast growing. So yeah, like I say, our ticket size is roughly like 50,000. It can be as low as 50,000, although we prefer to do 100. Up to about 500,000 would be our max. Although that doesn't mean you can't get other investors to come in alongside us. That's great. But that total raise should provide you with 12 to 18 months of runway, and we'll assess that during the due diligence process. I think I've covered this. Yeah, traction and growth. Yeah, as I say, like 100,000 would be probably roughly, if you're making $100,000 a year before we invest, then that would be the kind of timing that we'd be looking for as Renew Capital. But otherwise, I think, oh yeah, market size. Okay, market size. One of the things we're looking for is that, you know, is this a $1 billion market in Africa? And don't just like make that up, but like, is there somebody out there saying this is a $1 billion market and it's untapped? We've not reached its potential here. Okay. Okay. Let's say you sat through this whole process, the 40 minutes that I've been speaking to you so far, and you're like, yeah, Lucas, I get it. My business is growing like crazy. Stop trying to convince me that like I might be better off not taking on a outside capital. I've already decided I want outside capital. Now I just want you to tell me like how I can go about getting it. Okay, fine. Let's get into that then. So I see this as like roughly a 7-step process, if all goes well. And at any point, things can go wrong. Okay, stage 0, as it were, is you getting ready, and that's kind of begins hopefully with today, but it probably will take you about 2 or 3 more months, is my guess, unless, like, if you're trying to run the business as well on the side. If you've already got things organized, then okay, fine, maybe a few more weeks. Yeah, based on the pitch decks that I see, there's often a lot there's a lot more work that should be done at the early stages of this process. Okay, so sticking with my marriage metaphor, we've got stage 1, and that's the pitch. And this is the flirting stage, right? Stage 1 is the like, oh, hi, how are you? Yeah, nice to meet you. Where'd you go to school? Whatever. I don't know what people say when they're dating. I've been married a long time. But like, this is the flirting stage, right? Where you're like pitching and getting to know each other. Stage 2 is the light due diligence process, right? This is the like dating stage, right? You might even be dating a few people at once. It's not that serious, okay? I'm not advocating that approach. I'm just saying that like sometimes like there's more people in the picture than just one at the early stages of relationships. Okay, then term sheet. That's stage 3. That's the engagement, right? That's the ring. Okay, the first ring, as it were, and that's when things are like, oh, yeah, you're meeting her mom and dad, you're meeting his brother, whatever the story is. Okay, this is like serious. Okay, then you get into due diligence, and this is the engagement period. This is where the little sister is like, Hmm? You're going to be dating my sister. You're going to be married to my sister. I'm going to want to know what's going on here. She's going to be talking to your friends. She's going to be talking to your old boss. She's going to be wondering what happened in your previous relationships. Okay, this is like this is the police check process of the relationship. Okay, then it's step 5, the close. This is the get married part, right? Now you are like, okay, we're in this together, and we now have to grow. Okay, for some of you that might mean growing your family. In the case of an entrepreneurship process, it's just like, I want to see your business grow. Okay, and yeah, like pregnancy processes taking 9 months is not the speed of growth that we're looking for in the private equity, or frankly in the venture capital world. We want to see much faster growth than that. And then finally, stage 7 is the investor exits. And almost every investor that I can think of ultimately aims to exit. Whether that is an amicable exit, as in, you grow old together and walk off into the sunset kind of exit, then okay, great, that's wonderful. Or it's a divorce of some kind. I've seen it happen in both ways. Then that's very much up to you and the investor that you bring on board. And so, but if I had to summarize it, like that's the process. And the pitch is sort of your first best opportunity to make an impression with the investors that you're getting to know. Okay, they see a lot of pitches. So the compelling story about your company needs to be memorable. This is like, okay, I'll dispense with the relationship metaphors, but I think you get the point. It's like this is you and your business in like 3 to 5 minutes, and investors hear a lot of pitches. So this is the first time they're going to hear about your company, and like they need to be able to really quickly understand what it is that you're saying. Your grandmother should be able to understand the pitch. If your grandmother can't understand what you're saying, then you're not ready for this pitch, as it were. It should be high level. It should be engaging, and you need to make sure your audience stays with you the whole time. And as I say, it needs to be memorable, because they need to be able to. They might hear 20 pitches in a day, so they need to be able to remember you at the end of that day. This is a multi-step process. Remember, if I go back to this, it's a multi-step process. So you have to. You don't have to. Look, you can do whatever you want. My experience is, if you think of this as the first of many meetings, rather than I got to tell them everything I possibly can about my business, then that goes better. That's a more effective approach, and it will force you to be really clear and really concise with your idea, which just means that you really, really need to understand your business. You need to know your business inside and out, and you've got about 3 minutes to get that out there. It's not just the deck, it's the meeting. Back to that point I made earlier about trust and about the relationship you have with the investor and the investor has with you. It's the meeting where that takes place. And it's really hard to do over a Zoom call like we're doing now, right? Where it's like, how am I supposed to get to know you over a Zoom call? Like, I hope you have a decent sense for who I am at this point, but like, I know how hard that is. and we try wherever we can. We almost never invest without meeting the entrepreneur in person. But the first time round, it very often is over Zoom or Google Meet or yeah, whatever the case might be. So it's the deck, and we'll talk about the deck in a second. But it's not just the deck; it's also the meeting more widely. Okay, I promised the deck. So here's the point about the deck. Each slide needs to have a key point. That's like I'm sure you've all been given lots of advice about PowerPoint, and I'm not trying to suggest that advice isn't valid, but my experience is you should be making one key point per slide. In this case, on this slide, my point is related to the pitch deck and the contents of the pitch deck, right? But on my next slide, it'll be about pitch day and what to cover on the day of the pitch, okay? So one thing per slide. What's your point? The other thing is that in my experience, charts are great, photographs are great, but if I can't read it, if I'm like looking in at the screen to see what's going on, then you need to work on it more and choose a different chart, choose a different picture. I don't know what it is. And you're going to need to practice like probably 10 to 15 times with people that will give you really honest feedback. I don't know about you, but like my kids are brutal when it comes to this kind of thing, and they will like leave me with scars if they feel that that they're not understanding. So like practice with someone like that, your grandma, your aunt, your I don't know, your boyfriend, your girlfriend, and ideally it's someone who doesn't understand your industry at all, because many of the investors that you'll be dealing with, they might understand like your industry broadly, but they probably won't know anything about your particular solution. You have to be able to explain your solution to someone who really doesn't know it. And if it's one of the big tests that we use when we say to founders, sorry, can you just explain your idea to me in really simple English without using any jargon? Make it so that my 8-year-old is going to understand what's going on. To that end, the sandwich is a great way to do it. Strong opening, keep them engaged, memorable closing, high five, and you're out of there. Like that's the that's the method that I find has worked best for us. You can use a template, and actually Robert will share our template with everyone afterwards. If they want to use it, they're welcome to. But if we see our template sent back to us, it's always like, okay, like this needs to be yours. The template is only valuable in that it helps you have one thing per slide, but like it doesn't. It needs to be customized, right? It's like, put your own stuff into it. What's your point? What's the thing that makes your business special? Okay, then on pitch day, you've got to be ready. You need to know who's in the audience. Is it a venture capital firm like Renew Capital? Is it I don't know, is it a private equity firm that's looking for slower growth? Is it an impact investor that's looking for both impact and some return on investment? The more you know about them, the more ready you will be, and the better you're able to customize your presentation to the kinds of questions that that investor is going to have. Show up early. The number of times, I can't tell you the number of times people are like logging into the pitch, like 30 seconds before it's due to start, and then their microphone doesn't work, or their headphones are like out of batteries, or I don't know, their camera's all blurry, or they can't figure out how to use Zoom because they always use Google Meet. Like, I I get it. That's really annoying when that happens. But to me, it just says not ready. And it's brutal that that's true, but like that's what every investor will tell you is like, okay, like like when we were ready, you weren't ready. And that's what they're going to remember. Have a stopwatch next to you, know how much time each slide is going to take, and be ready to move. You've only got 3 to 5 minutes. You need to keep your energy up. Sometimes I get the sense that folks are in like a really dark room, or that they, I don't know, that they're just like not, that they've had a really late night the night before, maybe, or something. Like the meeting is everything, right? And so if you're trying to convince an investor that you're a salesperson, as most CEOs really need to do, then they need to believe that you've got the energy it takes to make that sale happen. And finally, don't read your slides. It's a story for those of you who have kids. You'll know this. Like kids get really bored when you just read what's on the page. You have to be like, oh look at what that guy's doing. Like it's like, there's a whole thing that goes with reading a story to kids, and the same is true with investors. The words on the page, they can read. You don't need to read those. What you are saying is what brings those words to life. And then finally, make sure your numbers are right. I cannot tell you the number of times that we've got like a pitch that goes up, and the investor and the company's like, oh yeah, but these were like 3 months ago's numbers. I just haven't updated my pitch deck. It's like, well, really? You didn't take 10 minutes to update your pitch deck? Like why? It's like, why didn't you do that? Like, so strange. It's, this is a pretty important meeting. I don't know. I feel like this is the one time that, like, having your numbers up to date would probably be a good idea. Oh, yeah, good. Okay, I'll do that. Finally, and I've already covered this, show your energy, smile, be human. We are human, despite what it might feel like for you. I know it's nerve-wracking. As I say, I've been on the other side of it. But, like, we make mistakes. We often, will ask really dumb questions. It's okay to laugh. It's okay to smile. Like, back to my whole like relationship metaphor, like if this is sort of the first time you're chatting with someone, then it's okay that it's a bit casual and it's a bit fun. We get it that you're selling your dream, and that you're looking for us to buy into that. And so tell us what your dream is. Like that's wonderful. Okay, you'll get these slides, by the way. I'm sure someone's going to ask, can I get the slides after the presentation? Yes, we'll get you these slides after the presentation. You'll be able to click on all of these links. And there's a bunch of pitch decks that are available, including, I'll put on here the Renew Capital pitch deck, and you can download it as you like. Okay, so let's say you get through the pitch, and you've done the light DD stage, right? And we get to the engagement stage, right? The term sheet's been issued. So we're going to close the deal, right? When the deal is we're getting married, and we're like closed. We've got a date, right? We've got a date, and basically now is the due diligence process and the negotiation process. A term sheet, that engagement ring, okay, the term sheet is a non-binding agreement that sets out the basic terms and conditions of an investment. This is so important, okay? This is like, this is the part that like really matters when you're negotiating. And you should not that this is just like, oh, this is our standard term sheet. It might be their standard term sheet, but if it doesn't work for you, then you should be ready to walk away, because this is the part that determines the legal agreement that follows and sets the stage for the whole relationship that's going to happen afterwards. And you need to be really comfortable with every single letter, every single character that is in this term sheet. And if you're not, then you absolutely have to start the negotiation process at this stage. Okay? Because if you wait until the legal documents arrive, then it's too late, basically. The legal documents really are standard. Those are like, basically, like in the case of a safe note, which is what many of you will probably want to use, those are like, that's a template. So the terms are the things that are really, really important and what go into the contract. Some of these things will change as you go through the negotiation process. So it's really important that you share early. As new information is discovered, terms might change. It's not the end. The contract is the end, but the term sheet is the clearest thing you have to the investor saying, right, I'm serious. Like, I'm ready to do this thing. Are you ready to do this thing? Because if you're ready to do this thing, then I'm ready to do this thing. And so this is like everybody's moving. I'd love to hear in the chat. I would like, I've got my chat up, and I'd love to hear if stick it in the chat if some of you have received a term sheet in the past. And I'd love to hear what the most challenging part of the term sheet process was for those of you who have received one. But the short story for those of you who haven't seen one is that it's like a blueprint for the investment. It's 3 to 5 pages, probably. Some people's can be as long as like 15 pages, but yeah, for the most part, they're quite short, and it has standard sections, and it might even have the standard clauses that an investor uses. But that doesn't mean those standard clauses work for you. And sometimes they're signed in hours. Usually that's a bad sign. But sometimes it can take months to sign, for you to be comfortable signing that term sheet. My sense is that it should be, ideally speaking, it should take about a week. Because if you're dragging it out, then like that's usually a bad sign. So I would see too fast as a bad sign, but also too slow as a bad sign. And we've had cases where it's dragged on for like 3 months. And if that's the case, then it's like, well, what are we doing here? You've probably all had these friends. Maybe you are this friend, but but the one who's like discussing the engagement with their partner, and they're like, well, what about this? What about that? It's like that might work in relationships. I'm not saying it won't, but I certainly wouldn't see it as like as an enthusiastic endorsement of the person that I was considering getting into a relationship with, if there was like a 3-month negotiation over the term sheet, basically. And if the bridge is too far, then it's going to be too hard. And you should just be prepared, as I said earlier, to walk away, because the terms may just not work for you, and and that's okay. Like, there will be other investors out there that you can approach, maybe, and try to work a deal with them. And yeah, and if that's okay, then both sides should be willing to say, okay, no problem. Like, we love your business, but the deal wasn't possible. Then yeah, no trouble there. The key aspects of an investment readiness process are a well-defined business plan, and that generally comes in the form of a pitch deck. And that pitch deck might get more and more detailed as you go through the process. But the due diligence process that we get into with, and we're no different than any venture capital firm in this respect, the due diligence process will look for evidence of the fact that, you know, you've made these claims. Now we're looking to see, like, you know, show us the financials, show us your bank statements, show us the fact that you have, I don't know, 1,000 people signed up for your product. Like, I want to see that. I want to see that list of people that are signed up for your product. You say you have a waiting list, but like 40 of the 80 people on that waiting list are your family members. It's like, well, that doesn't count, you know? So that's the kind of thing that an investor will get into. To the extent you have any intellectual property as part of your business, you know, that's going to want to be want to be investigated very, very closely. We have lawyers. We'll expect you to have lawyers working with you. We try not to make that expensive, by the way, for you. Some other investors will insist on a quite expensive process. I would say we're pretty fast and pretty light as far as our due diligence processes go, but others will take longer. Here's a sense for that timing. We'll want to see a financial model. We'll want to see your 2024 12-month budget and actuals, if you have it. And if you don't have it because you're too new, then, you know, whatever you have from 2025, your financial model covers the future. We'll want to see cash burn and runway analysis. We'll do that analysis as well on your cash burn. So you'll do it, and then we'll do it, and we'll stress test it. Quarterly financial statements, monthly management accounts for the last year and a half, probably, since the latest financial year. We won't go back like 10 years or anything like that if your business has been around that long. If your business has been around for more than a year, then we'll look for audited financial statements, and we'll look for some audited cases, like, you know, basically like any management letters from external auditors, that kind of thing. We're going to want to see that. Bank accounts, bank statements I've covered already, and then customer and market information, like that sales pipeline and tracker. What are you using to track sales? Is it like you've got a notebook? Like, okay, might work, but are you using HubSpot or one of the other, so Zoho, some other CRM manage your sales process? Then we're going to want to investigate that. Then we're going to by the way, we're closing in on the end here. I promised I would leave lots of time for questions, so we've just got a couple more slides. The most common things that are missing, or the main bottlenecks, if you were, is that we usually find, we can be the bottleneck, by the way. It happens, but I would say it's pretty rare. We're usually in a position to turn around documents within a couple of days of receiving them. It's more usually on the investee side that that they're not ready, basically. So financial statements are missing. You're not following a checklist. And I know every investor will have its own checklist. I'm sorry, that's just part of the deal. Like, we can use other investors' due diligence documents for our own process, But if they didn't ask for something that we need in our process, then we're going to ask you for it. And so, the checklist is there, and we expect people just to follow it. Often we get no response just because, there's just like a lack of responsiveness. And I get it. You're probably back to my dating metaphor, you're probably dating a few investors in this process, and it's hard to keep track. And maybe our terms are not as attractive as others. So you're like, well, let me just see, maybe like that other firm is going to come in later or earlier, and then Renew Capital will follow. Maybe. But if the process drags on too long, then everybody just loses interest. And it's always better just to be quick, fast, transparent, and don't leave somebody waiting for a response. And then sometimes the financials just don't make any sense to us, and we need to get on the phone and walk it through with you and say, like, why are you assuming this? The financial model is the one where this usually comes up most often. This is impossible to see on your screen, and is really meant for it to be a resource for you later. But it is it'll give you a sense for financial management, and what we look for on our financial due diligence structure. So have a look at it later if you're about to go through the financial due diligence process, and maybe it'll be helpful. And then finally, again, it's a little in the weeds, but the short story is that Renew Capital, like almost every other venture capital firm on the continent, will probably insist on you having a holding company, whether it's in Delaware or Mauritius or the UK or France or otherwise. We're almost certainly going to insist on a holding company structure. There's various reasons for that. The main one I would say is that we need to have confidence in the legal system where your company is based, and we have that confidence in some jurisdictions and not others. That's just based on our experience in doing business in those countries. So, and not just our experience, but kind of the collection of legal experience for investors. And so this is a process. Like, it does take some time. And depending what country you're registered in, it can take a couple weeks or several months. So, but we cannot do the deal unless it's done, unless this process is well and truly, totally complete. And we have very rarely made exceptions to that, and almost always found that it came back to be a problem. So we really try not to make any exceptions. And then finally, there's some additional resources that you'll receive when you get this deck at the end of, well, probably the end of the day. And you can click on these links, and there'll be a few things available to you, like the investment readiness training, which is taught by the co-CEO of Renew Capital, Matt Davis, which is a longer training program that gets you ready for private investment. There's a closing the deal training, which is taught by our general counsel, Chudi, and he walks you through like the documentation, the like real nitty gritty of the closing the deal process that you'll need in place. And then finally, there's our due diligence checklist, which is our generic due diligence test checklist. And then depending what country you're in, we give you another due diligence checklist, which is kind of related to the country that you're operating in and registered in. So with that, I will pause to take a quick break and have a drink of water and look in the Q&A section and try to find some of the questions that you all have been asking. Where is it? Yes, Q&A, great. And I will do my best to answer your questions. So give me half a second. Um, Great. Okay, some great questions coming in here. Good. Okay, Helen, Mary, I'm gonna answer this one first, Helen. The question is Renew Capital focused on tech investments? Please share similar investors in the agribusiness space. Okay, so we tend to invest in the tech-enabled asset light space. So we're not really in the hardcore tech space, but tech-enabled asset light. So agri-tech would fit that category quite well, I would argue. And we've invested in a couple businesses that are in the agri-tech space. One you might know, Helen, I don't know where you're based, but in Kenya, there's a company called Farm to Feed. Renew Capital is a proud investor in that company. We invested about a year and a half ago, actually, in Farm to Feed. They're doing really, really well. That business has developed a very clever tech solution that enables farmers to sell kind of the produce that would ordinarily be wasted on a farm. They buy that produce and they sell it. And they can do that because they buy it at a slightly lower price and they get carbon credits for selling for buying the produce that would otherwise normally be thrown away. Something like 50% of produce is thrown away before it even makes it to market. And Farm to Feed aims to reduce that by buying much of that produce. So they call themselves the odd-shaped solution to climate change, and it's I think, a really exciting business. So that's one business. Others that you might want to look at if you're in the ag space. So Catalyst Fund is one that we do several deals with them. Depending how big your business is, Proparco are interested in this space. FMO are interested in this space in the kind of large investments territory. You may want to look at Agra, which is a charity, basically, organization funded in large part by the Bill and Melinda Gates Foundation and others, as USAID actually, as was. But they still have some money. Don't worry. There could be something to go at there. Helen, who else is in this space? Acumen Fund do some work in the agri-tech space and the agri sector generally. Without knowing too much more about your business, I'd say like that those would be where I would start. There's several more quite specialist funds, but I would say those are a good place to start. Okay, Collins says, how can I get an angel investor to listen to my pitch immediately other than waiting? So the short story, Collins, is I would say you need to go to where they are. They are unlikely to just find you. In my experience, that involves spending time at some conferences. I myself spend quite a bit of time at conferences in and around Nairobi, but also Kigali, Kampala, Ethiopia, and Addis mostly, although even further afield. I'll be in Zambia next month. yeah, so they're out there, but you do need to sort of seek them out. LinkedIn is great for that, to be honest. I kind of hesitate to even mention it because, to be honest, it's a bit painful receiving dozens of pitch decks through LinkedIn, but it works sometimes. And I think an honest, not a spam kind of approach, but like an honest to goodness, like bit of research on who angel investors are in your sector, find out where they've invested, find out, who's your competition, who's invested in them, see, kind of like you got to do some research here. And you're going to have to, really, yeah, like investigate who the angels are in your ecosystem, and go find them and seek them out. In the case of Nairobi, I don't know, Collins, I don't know where you're based, and there's so many people have put in where they're based above, so I can't quite see. But if you're based in Nairobi, I would recommend NIBAN as a place to start. That's the Nairobi Business Angels Network, and I find them great. They'll look at your deck, they'll give you some feedback, and come meet them. Go meet them. They're not hard to find. So check in with them. You also asked, Collins, how much it would cost to get someone to review the idea and help you prepare for a presentation, like an angel, like to an ideal angel investor. It's the kind of thing that Renew Capital does. So depending where you're based, I'm sure we'd be happy to have a quick meeting with you and give you some ideas. The contacts, I'm pretty sure for Renew, are listed in the presentation, and or they'll be in the presentation that you receive after this. So you'll get a sense for that. Okay, Kelvin says, my agri-tech startup is still very early stage, so we're not yet ready to formally pitch. However, he'd appreciate it if we'd be willing to review his pitch deck and give some feedback. Kelvin, sorry, I was almost calling you Kevin, sorry. We'd be happy to do that. So you get in touch and we'll give you a quick bit of feedback, and depending where you're based, someone's probably happy to have a coffee with you. By the way, Calvin, this is a great idea. I don't know if this is conscious on your part or just something that came naturally to you, but investors love it when you come to them before you need money, and instead are just looking for some ideas around, whether this would be the kind of business that would be interesting to them in, say, 9 months' time. You get on their radar, you have a coffee with them. It's like, sorry, back to this whole relationship metaphor. It's like, basically saying, I'm not ready yet, but when I am ready, you're the kind of people I love to talk to. And that's great. It's a really good way, a low pressure way to know each other before there's lots of things on the line. Valdemar Walters says, let's imagine you only have an idea with promising returns. How do you pass the due diligence phase? Valdemar, the short story is, this is going to sound really harsh. I don't mean this to sound harsh, but in my experience, ideas are a dime a dozen, and it's the implementation that matters. So if all that exists is an idea on a piece of paper, that is going to be really, really hard. I don't know many investors that would look at that and go, yeah, this is brilliant. Like if you were in Silicon Valley and you had gone to Stanford and you were the top of the class and you had worked for Google for 5 years, and you had worked for Uber for 5 years, and you had worked for, I don't know, ChatGPT for 5 years, and now you were like, all my experience says that this is the one idea that is going to be like, that's going to blow the market wide open, then maybe someone would give you the time of day. But the truth is, I just like, I don't see it happening very often. And I appreciate that's not probably what you were hoping to hear, but um but we like, the grit is what it takes to make a business successful. And like, really the only way to show grit is to show that you've had that experience. So like, an idea, it's not enough to do that, basically. Don't take my word for this, Valdemar. Like, if I like, keep trying. Like, it's just been my experience that that's the case. But like, I don't want to be the reason you give up on an idea. I would just say that in my experience, it takes more than an idea to get a business funded. Chilumba asks, what's the best way to look for investors? We're in the finance space in Zambia. Yeah, go to conferences, join an accelerator, apply to various accelerators, go in and talk to other investors. We almost never do a deal alone. Like that, just like, yeah, like, it almost doesn't happen. And so, like, if you talk to anyone at Renew Capital, they'll be able to tell you 10 other investors that are active in the space. So, I would encourage you to just go in, talk to folks. Chilumba, down in Zambia, the Renew Capital employee's name is Calvin. And Calvin is a wonderful human, and he will very happily have a coffee with you, I'm sure. So yeah, pop in, say hi, get in touch with him, and yeah, go see what he's up to. Okay, sorry, another question from Helen under the capital criteria part. She's asking me to explain, is not on the IFC exclusion list. So, Helen, the easiest thing to do is just Google IFC exclusion list, or stick it into ChatGPT. What's on the IFC exclusion list, and it'll give you the list. But the short story is, this is a list of industries that the IFC will not invest in, and as such, Renew Capital also doesn't invest in them. And it's shorthand for industries that, that are like, how can I put this? Like, yeah, there's like challenges or moral consequences around some of these things. For example, producing weapons or illegal drugs, or I don't know. You get the idea. It's not a long list, but have a look at that, and you'll find it. A Fenturnt, I hope I pronounced that vaguely right. How can I get a loan at a lower interest to boost my business? That's very difficult, but in my experience, it's easier when your business is having some development impact of some kind, and a development institution would then be willing to take it in order to have a development impact. So in the case of my lodge that I mentioned earlier in Ethiopia, we were able to get a loan, a US dollar loan at 8% interest by having a number of conservation related goals alongside the financial goals that we have as a business. Now, some of you might be thinking, 8%, my God, that's actually a lot. That's actually a very high interest rate. And at the time, I thought so too. But I have to say, like, you know, when you look at the risk associated with lending to a small or a medium-sized enterprise in Africa, 8% doesn't begin to account for the risk. And frankly, nor does 12%. Like a bank, entrepreneurs complain all the time that 12% interest is too high. And I also complained, by the way. But the truth is, it is an exceptionally risky business, lending money to small and medium-sized enterprises on the continent. And there's a reason why banks basically don't do it. And it's because it's basically bad for their business and bad for their bottom line. That sucks, to use a technical term. But in my experience, it's very difficult to collect on a loan from a small and medium-sized enterprise. And it's why they often will ask for collateral. Now, what you'll find is that many non-banks, but kind of or newer financial institutions or bank-like businesses are willing to lend you money, probably at a slightly higher interest rate, by looking at more advanced metrics, like what's your revenue, what's your customer profile, what's your non-performing loans on your own. Let's say you're lending money to your customer in order for them to buy your product. What's your non-performing loan success rate? And those are the kinds of things that in my experience, businesses now increasingly in Africa are doing. And those businesses, by the way, are growing like crazy. And we love talking to those kinds of businesses at Renew Capital. It's called embedded finance, and it's I think we're going to see an explosion in this kind of business. So sorry, that was sort of the long answer. The short answer is impact investors are sometimes willing to do a lower interest rate if you're having development impact. If you're not having development impact, like either through a large number of jobs or a serious commitment to climate issues, then I think you're probably looking at more like private finance, and the interest rates are going to be higher. But if your business can handle it, then I wouldn't necessarily shy away from it just because it's a high interest rate. If it'll help you grow and you think your business can handle it, then I would say that's fine. Alan Kamani asks several questions, but Alan, I hope you don't mind because we're short on time. I'm only going to answer a couple of them. One of them is how much skin in the game in the investment contribution would you expect of a founder, I guess is your question, Alan, in Africa / East Africa? That's a great question. So for those of you who don't understand the question, what the question's asking, I think, if I've understood it correctly, Alan, is that basically how much is the founder expected to put in? Like how much of his or her own cash is expected? We don't have a formula for that, Alan. And actually, we don't even always ask right off the top. Eventually we will. Eventually it'll become clear through the due diligence process. What's more important to us is that you're all in on this. We rarely invest in side hustles. So if you're not all in, then it's hard for us to be all in. And so what we're more thinking about is like, are you giving up a salary in order to make this thing work? Or is the business so successful that you are paying yourself? Even better. That's great, by the way. Like I love it when I see founders paying themselves a salary. if the business is profitable. If the business is not profitable and you're paying yourselves a really big salary, then I start getting really nervous. Like, you know, nothing says bad plan if like we ask, well, what are you going to do with this money? And the founder's like, I really need a new car. And I'm like, I can't afford to keep living without a salary. It's like, yeah, I know how hard it is to live without a salary. That I've been through that. I know that pain. My wife also knows that pain. But like that's not what outside capital is designed to solve. And so that's more for us. That's more important. One of your other questions, Alan, you've got some great questions here, but one of your other questions, and I think this will have to be the last one, I'm afraid, folks. But one of your others was, are DFIs or institutions in Africa providing technical assistance or training to entrepreneurs who help them to be investor ready? And is our training free or is it charged, and how much? So, Alan, the short story is our training is free and you're very welcome to apply, and just get in touch with anyone at Renew Capital to find out how the process works, and you'd be welcome. I can't speak for WYLDE and their process. Njeri, maybe you want to cover that, and maybe with that, I'll leave it there, and I hope that's been helpful. There's dozens of great questions here, so thanks so much. I think we'll get the questions afterwards, Njeri? And I'll take a stab 10 minutes later today at trying to sketch out a few answers after the fact.
All right, thank you very much. Yes, let us give those virtual claps. That's truly been a masterclass in investment. So thank you very much, Lucas, for that. We have come to the end of our session, and as Lucas has said, some of the questions, the responses will come to you as we send you the recording. We have put our contacts in the chat. And one thing we can wish you is all the best. Yes, there's a lot of work that you have to put in to be able to make sure that your business is standing in good light, because all someone is looking for is, can I trust you with my money, and are you going to give me what I'm looking for? You also can be an investor, and so you have heard what it means to be an investor as well. So wish you all the best. Coming to 2 minutes to the top of the hour for those who are around East African time. So all the best in the fourth quarter of 2025, or for you who is beginning like a new year, whichever is the case, coming into September, we still also wish you all the best. Bye for now.
Thanks, everyone.